Okay, ladies and gentlemen, welcome to this first afternoon session of the AMA Theatre at Morgan Business Expo. I'm delighted to have reached a point in history, I will call it. Linda Blackwell has been working on the Mortgage Market Review for longer than she cares to remember. She had just finished university when she started on this project. No, it's not quite true. But this has been a long programme to get us to a solution which actually I would hold up as a model from a regulator of how consultation should be done. And I think that's an important thing to say. We are very critical often of our regulator. They often get it wrong. They know they often get it wrong, and they admit it when they do nowadays, and I think they always have. We don't praise them very often when they get it right, and we should do, because we get the regulator we ask for and we deserve and we pay for. In this case, I believe that the regulator has listened to all parts of the industry and the consumer lobby and tried to come up with a balanced set of proposals that work for consumers, and if the industry genuinely takes it on board and participates with it, will work well for all of us. And I think that is the challenge we have. I'm delighted that Linda's agreed to come and talk to us today about how she not just sees these, talks about what is in the paper, but also the background and the thinking, and a little bit about how she hopes implementation will work, because that is the key to this. It is not about what's on the paper in black and white, it's how we interpret it and how they interpret it and how we bring it to life in the next 12 to 18 months. So that is the big challenge for us. So I'm delighted that Linda, who has been working very hard for the last 4 years with her team to deliver this, has agreed to come and talk about this today. So I'll give the stage over to her and then we'll do questions and answers and try to get us to a point of happiness. Thank you. Linda.
Okay, well, good afternoon, everyone, and thank you, Robert. It is quite nice to get some nice comments, actually, from the industry. And thank you for the invitation to come and talk to you today. I think we are all relieved that the speculation is over and the MMR has landed. I certainly am, as Robert said. This has been a very long haul. We've been a long time getting here, and you just need to look at all the papers that we've produced on the way. We've produced 11 papers. It's about 2,000 pages worth, a small forest, representing a lot of analysis, debate, and discussion about what we want to do to put things right. And I think that the engagement from the industry has been fantastic, and I think that at times it's been really very challenging. We've faced some tough times, but on the whole we've enjoyed a really constructive, open and collaborative dialogue with firms, AME and the other trade bodies, and I really do think that has helped us get to the right place, and I'm pleased to hear the comments Robert has made. We do think that the MMR is going to make a difference, and that it's nice to see that the industry agrees with us that it will achieve the aims that we set out to achieve, which is allowing continued access of mortgage finance to the vast majority of people in this country that can afford it, whilst at the same time doing something about the tail of poor lending practices that we've seen in the past. Of course, it's not possible for us to please everyone about everything, and we can't expect to do that. But the consensus view from the feedback we've received is that we have ended up with a set of rules that are proportionate, sensible, and that the industry tells us they can work with. I don't think there are any surprises in the final package. We've been a long time getting here. I think some firms have been pleasantly surprised about the fact that we've given the market 18 months to implement the changes, but we do understand that the cumulative effect of the MMR is really quite substantial. It will lead to significant changes in terms of policies, processes, systems and staff training. And that would really have made the usual 12-month period that we give firms challenging, particularly for the smaller firms. And we've also had regard, as we said we would, to market conditions. The continued subdued market conditions means that giving firms a further 6 months is unlikely to result in any significant consumer protection risks. So 18 months in which to implement. In relation to the MMR itself, we've taken forward substantially unchanged the majority of the proposals consulted on last December. And so what I'm proposing to do today is just to give you an overview of the key elements of the package that are likely to be of particular interest to you as intermediaries. So starting with responsible lending, I think it's worthwhile remembering that there are quite a few things that we considered and discarded along the way. And actually, as I'm just sitting talking to Alex, he said to me, frighten them to death at the start, and then it all starts to get a bit relative. So we did think about LTV and LTI ratios. We thought about banning particularly high-risk lending combinations, the so-called toxic risk combos. We talked about imposing a maximum term and the additional buffer for the credit impaired. But discussing that with the industry and the consumer groups, ultimately we felt that those were really blunt measures that would have prevented some consumers accessing mortgages. And we preferred an approach that where all consumers can get a mortgage as long as they can demonstrate they can afford it. So we ended up proceeding on the basis of establishing a clear principle of good underwriting amongst lenders, the affordability principle. And the affordability principle has three key elements. So lenders must assess affordability. They can't just rely on increasing house prices and then ignore the borrower's ability to repay. This affordability assessment has to take account of the fact that interest rates might rise in future. Borrowers shouldn't be given a mortgage which is only affordable on the basis that interest rates aren't going to go up and that initial low rate that they have managed to get is going to continue forever. And interest-only mortgages must be assessed on a repayment basis unless there is a clearly understood and believable strategy for repaying out of capital resources. Customers must be in a position to pay the capital as well as the monthly interest payments. So this is an approach which allows lenders the freedom to make lending decisions while ensuring those decisions are properly informed based on the circumstances of the borrower. And lenders will undoubtedly adopt different approaches to this, which should allow you, the intermediaries, to demonstrate your value in helping customers find the best and more appropriate offering. So, as we're making the lender ultimately responsible for assessing affordability, to ensure our rules are very clear on this point, we've removed from the mortgage sourcebook all the detailed existing regulatory requirements for checking affordability from intermediaries. Now, that's not to say that you won't have a discussion with your customer about what they can afford. In fact, the first thing the customer is going to want to know when they walk through your door is, how much can I borrow? But the only regulatory requirement on you is to establish whether the customer meets the lender's expected affordability criteria. So in terms of regulation, we've stepped back from your responsibilities to be absolutely clear that it is the lender who is responsible for assessing affordability. We expect real consequences to flow from this. First, the lender must take account of the customer's income when it makes its affordability assessment. So in every single case, the lender must obtain or ensure the broker obtains reliable evidence to confirm the income stated on the mortgage application form and ensure that affordability assessments are based on fact. This is going to mean an end to self-certification mortgages and the end of fast track where there is no verification of income. As well as ensuring that the affordability assessment is based on fact, we expect this to have a really significant impact in reducing mortgage fraud, which is still a really major concern in the mortgage market, costing the UK something in the order of £1 billion a year. So the overall market correction since the crisis has already had an effect in reducing the number of mortgages where income is not verified from around 50% in 2007. In fact, in quarter 1, 2008, it was running around 55%. And that has reduced today to 23%. which is still quite a high figure, really. Some lenders, I have to say, have always verified income in every case. We've seen quite a number start to do that since 2007, but there are still quite a number who are reporting income non-verified mortgage sales. Indeed, some still fast-track a substantial number. So one major lender, for example, in Q1, Q2 2012, reported to us that 55% of their mortgage sales were still income non-verified. Some lenders continue to rely on intermediaries to obtain and check evidence of the customer's income and do no more than spot check a relatively small percentage of cases. That's the lender's choice, but they can't use that as a way to avoid responsibility in future. It is the lender who's responsible, and it is the lender who will be held fully to account for the income checks. Given that they're ultimately responsible, lenders who choose to outsource will want to ensure the quality of their fast-track business, and for you, that is bound to have some impact. For those intermediaries who are confident in their own processes, it shouldn't matter whether a lender fast-tracks or not. That's a decision for them. But I think this is bound to have the effect of driving up standards, and I think that's something that we all welcome. I was really interested to read this morning. In fact, I don't know whether it was here, Robert, but the Institute of Financial Services reported today a 10% uplift in the number of brokers registering for the Diploma in Mortgage Advice and Practice since the MMR was published. So that's voluntarily going the extra mile, because of course we haven't changed the qualification under the MMR, it's a level 3 qualification, and I think that's really good news. Another real consequence of the new rules is that lenders and borrowers will no longer be able to rely on the underlying collateral or increasing house prices as they have done in the past. The obvious example of this is interest-only mortgages, where for quite a number of people there has been an unrealistic expectation that house price inflation is going to return to the level of increases we've seen in the past, and that they'll have sufficient equity in their property at the end of the term to be able to sell and downsize. But just how realistic is that? If we look at what's happened to house prices, for some, the gamble will clearly have paid off. If you took out an interest-only mortgage to buy the average house in 1980 for £22,000, those were the days, it was worth around £180,000 25 years later. So selling up and repaying the capital may not have been a problem. But we are not going to see the annual house price inflation returning to double figures anytime soon. And it does mean that people have to sell up their homes and leave. For some, that will be okay, and we, under the MMR, we've allowed for downsizing. But some won't have enough money to buy another property. There's a tendency for consumers to forget that actually all house prices go up, and not just their own house price. And most people don't want to sell their homes and don't really appreciate that that is actually what has to happen. It's very easy to say 25 years ahead of the time that I'm going to sell, but it's not so easy when you get there. And I think there's quite a number of lenders that are finding that right now. But we do accept that interest only can be the right product for the right customer. We do expect that it will become a niche product in future. And I think we can see movements in the market already, which is pushing it into niche. Under the MMR, the intermediary's responsibility for interest only is limited. All that you're required to do is to alert the consumer to the fact that they will have to demonstrate to the lender that they have a clearly understood and credible repayment strategy in place, so they won't just be able to rely on increasing house prices. Excuse me. There is no need to provide advice on the proposed strategy. There's no need to establish whether the strategy will in fact repay the capital element at the end of term. The responsibility for assessing whether the repayment strategy is a credible one is the lender's. So we have not stopped interest only, and contrary to popular myth, we have also not stopped or done anything to restrict lending to the credit impaired or the self-employed, to older people or first-time buyers. I mean, we are not stopping those groups from getting mortgages. I think that I'd particularly like to stress that in relation to the self-employed, we have not been prescriptive about what form of income the lender has to get in order to be able to verify the income. And we've made it clear that projections can be used where they form part of a credible business plan. Basically, under the MMR, everyone who can demonstrate they can afford it should be able to get a mortgage. We understand that in the current market, it's increasingly difficult for you to place cases with any degree of certainty that they'll be accepted. And there does appear to be a widening gulf between applications and approvals. I don't know, there was a recent article in the trade press which quoted research suggesting that over the past 5 years, over 1.5 million mortgage applications worth about £227 billion were rejected, and 60% of those rejected were for first-time buyers. I think over the past 5 years, there's been 5.5 million mortgage sales to owner-occupiers, which means that around 22% of mortgage applications have been rejected. And that links in with what the Housing Minister was saying last week, where lenders are telling him that 80% of mortgage applications are accepted. We certainly still see a steady stream of letters from consumers and MPs complaining that we are responsible, the FSA is responsible for lenders not being able to give them or their constituents a mortgage, when that is simply not true. The market self-correction in response to market conditions has gone way beyond potential MMR constraints. And while the flight to quality has led to the demise of many poor practices in the market, which the MMR aims to address, such as the withdrawal of self-certification products and the tightening of interest-only criteria, additional constraints imposed by lenders, such as the restriction in higher LTV lending and tighter age limits, have arisen through market conditions. The MMR does not prevent such constraints from being relaxed by lenders. And I actually think, and I've heard, that there's a general hope that now that the market has seen the MMR and has some certainty about the future, we may in fact see the pendulum swing back a bit. I'd like to think that we will. This is a scatter plot which I've shown often. We updated it for the latest policy statement. This actually demonstrates the really very significant reduction in risk appetite since the height of the market in 2007, and it plots the change in lending risks and arrears amongst lenders that lent in both 2007 and 2010. Those purple and yellow dots show the level of risk taking in 2007. The yellow, in fact, represent those lenders who paid the ultimate price and were no longer lending in 2011 or had to merge with other lenders. And the red dots show the level of risk in 2011 and the considerable improvement in performance. The MMR does not stop higher risk lending. What matters to us is that the customer can afford the mortgage. But I think we would expect in practice that by raising underwriting standards through appropriate affordability checks, this will reduce the number of higher risk products in the market. And of course, some of the larger lenders have built a one-size-fits-all, largely commoditized approach to mortgage lending in the interest of speed and efficiency. Because of that, I think some lenders will choose to withdraw from servicing higher risk customers in future because of the extra care they need to take to properly underwrite and judge the risk. But that's a commercial decision for each firm. I think it's really important that I stress that we are not being prescriptive and we are not imposing restrictions on lending. What we have done is no more than hardwire those 3 common sense principles of good underwriting that we looked at earlier into the system to ensure that the better practices that we're seeing today continue into the future. We do recognise that the MMR's strengthened affordability rules are likely to mean that some borrowers, those who self-certified income, for example, or those who took out an interest-only mortgage with no certain plans for repaying the capital, may have difficulty in remortgaging. To mitigate that impact, we have suggested special arrangements to help transition borrowers from the current to the new mortgage rules. And this is one area where we have rethought our approach since we published the consultation paper last December. I think everybody agreed that transitional rules are needed, but most felt that as we drafted them, the rules were too restrictive to help many borrowers and just too complex to be widely adopted by firms. Lenders came to us and told us that if we could just relax our requirements, they were more likely to use the transitional rules. So they wanted to make their own assessment about making exceptions to the affordability and interest-only rules. Now, the whole point is that we want lenders to use the transitional arrangements in order to help customers. So we are allowing lenders to do this as long as there is no increase in the balance outstanding. So as long as the customer isn't taking any additional borrowing, it's up to lenders to decide how to help the customer. The only exception to the additional borrowing rule is that where the security is at risk, so if essential repairs are needed, then that is going to be an exception to the additional borrowing rule. In those circumstances, the existing lender can advance additional funds for the repairs, subject to the lender getting evidence about the cost of repairs. Another key element of the responsible lending rules that might be of interest to you is lending into retirement. Again, we do not want to prevent lending into retirement where this is appropriate, but we do need and want to protect customers from carrying unaffordable debt into retirement. Therefore, we want to ensure that an expected drop in income in retirement is properly considered by lenders. We recognise that it's difficult to predict pension income with any degree of accuracy, particularly where that is a long time in the future. We can't expect lenders to crystal ball gaze. So what we proposed is that lenders adopt a prudent and proportionate approach to assessing income where the term extends into retirement. This means that the degree of scrutiny that the lender applies may vary according to the period of time remaining to retirement. I'm not going to cover debt consolidation. Basically, if it's a credit impaired, if someone who's credit impaired is looking for a mortgage, we're giving firms two options in terms of affordability. They can either take reasonable steps to ensure the debt is repaid themselves, or they have to assume that the debt remains outstanding and include that in their affordability assessment. So that's a quick run through the responsible lending rules. In relation to advice, well, I think it's all good news for intermediaries. Advice is a core part of the MMR, recognising that buying a mortgage is one of the biggest financial decisions a consumer makes, and that the vast majority of consumers opt for help and support throughout the buying process. So we have removed the non-advised sales process, and most interactive sales will be advised. Interactive sales can be execution only for mortgage professionals, high net worth borrowers, and business borrowers, i.e. those that we feel have the necessary support or are well able to look after themselves. Advice must always be given in relation to vulnerable consumers and in relation to high-risk products. So you must always advise someone taking out an equity release product, sale and rent back, right to buy, and those consumers who are raising funds to consolidate debt. This means that those consumers cannot use a non-interactive sales channel. So, for example, they won't be able to get a mortgage over the internet or by post. Execution only is also available where the sales channel is non-interactive and therefore it's not possible to give advice, and where advice has already been given has been rejected, except for sale and rent back customers, because we feel that the customer is in such a vulnerable position that it wouldn't be appropriate to allow them to proceed against advice. We do have concerns about the execution-only sales channel. I think we've been asked to expand execution-only into other areas. But when we consulted on execution-only, in fact, we were very hesitant to provide an execution-only sales channel. And we went out to the market and asked, well, how on earth are we going to prevent execution-only from being gamed? And actually the market could not come up with a suggestion about how it would be possible to stop it being gamed unless we restricted it to those customer groups. So the market actually came to us and suggested professional customers and high net worth mortgage customers. And since then we've added business borrowers. But we do have major concerns about execution only. We are concerned to ensure that it's not used as a gaming and as a way to circumvent the strengthened selling standards. So it's limited, as is set out in this slide, and there are a number of measures in place to prevent it from being gamed. So firms must keep records of the evidence that the customer is a mortgage professional, high net worth or business borrower. Where a consumer does purchase on an execution-only basis, they need to positively elect to do that. They need to know precisely what they want. And the rules require that the customer is made aware of the consequences of proceeding on an execution-only basis, no matter what the sales channel. So even if you're going down an internet route, you will have a big sign that tells you that you are not getting advice, and the consequences of that, you're losing protection. The rules make it clear that a firm cannot encourage a customer to opt out from or reject advice in favour of an execution only. And we are going to be requiring and expecting all firms to monitor the levels of execution only business, and we're going to take a very close interest in the scale of execution only business. One area that Robert got particularly upset about was our decision to rethink our approach to contract variations. If a borrower is varying the terms of their mortgage without any further borrowing, our view is that requiring advice is just wholly disproportionate. So we rethought our approach, and we have allowed contract variations to be completed without the need for advice, provided that there is no increase in the amount outstanding under the mortgage. If the sum outstanding increases, for example, if the transaction involves a further advance, then advice must be given. But Robert's particular concern was about retention deals and the risk of consumers being churned by lenders through short-term fixed retention deals and having to pay substantial fees each time. On retention deals, basically what we expect for it to be execution only, what we expect from the lenders is they send out at the end of the deal, they send out to the customer a letter which details all of the products for which the borrower is eligible. If the lender in any way steers the customer towards one or more of the available products, that will be advice, and the lender will need to consider with the customer whether the product is appropriate for the customer given their needs and circumstances. So what we are talking about here is you come to the end of your deal and you get from the lender a list of all available products. If provided with nothing but a list of available products, the customer then has a choice. They can do their own research, online maybe, and choose the product they want. Or they can seek the help of a broker. Or they can call the lender to ask for help in deciding between all the various products. In the case of those latter two, if they seek the help of the broker, if they seek the help of the lender, then that will be advice. There is absolutely nothing to prevent brokers actively seeking to help customers who are coming to the end of their deal. The MMR recognises that the majority of customers need and want help. Simply getting a list of all available products they could get might lead the customer to seek out help. And if they have a trusted relationship with a broker, why would they choose not to go to that broker to have that discussion? If they have done the homework themselves and they're happy to choose the product they want for themselves, we are allowing them to phone the lender or go into the branch, i.e. use an interactive sales channel to give effect to their instructions. So they pick up the phone, they get their letter, they see the list, they do their own research, pick up the phone and they say to the lender, okay, so I want that one. We're allowing them to do that over the phone because that's what most customers want to do, and that's a concession we're making in the interests of customer service. Where the customer phones the lender, they either instruct them to get the product they've chosen or they will get into a conversation about it. If they get into conversation about it, that is advice. I think Robert was particularly concerned, sorry Robert, I'm talking for you here, you were particularly concerned about the fees that the borrower might find himself paying. Well, we've introduced new rules that require firms to tell the borrower about the fee and ask them whether they want to roll it into the loan or not. So that's something that you must now ask the borrower. You can't just roll it up into the loan. I think that will prompt the consumer to think about it. And the consumer will, of course, also get the KFI. If a consumer who's already gone through the process at least once is happy to take out a mortgage on the back of a letter with no other conversation and is happy to pay the fee, then that is their choice. I don't know whether many consumers will do that, but if they do, they can. We're here to protect consumers, and sorry, Robert, but we're not here to create business opportunities for firms. We're happy that there are adequate measures in place to make the customer think about the choice they're making, particularly the new requirements around rolling up fees into the loan. And as I said, there is absolutely nothing to prevent you, the intermediary, from seeking out that business opportunity yourselves. Okay, I'm not going to spend much time on disclosure. Basically, we've taken forward the changes proposed in last December's consultation unchanged. So the IDD is no longer required. You can continue to use it if you want to, and we've left the template on our website. We've totally removed the scope of service labels. I mean, there's no labels whatsoever. We're leaving it up to you to explain in a clear and not misleading way any limitations there are in your service, and we've included examples of how you can do that in the rules. We've also changed the trigger points for the KFI so that firms don't have to give a KFI each time they give product-specific information. And we've given firms more flexibility to give comparative information outside of a KFI, i.e. the quick quotes. So you can give your customer a quick quote without having to give them a KFI. And of course, for direct-only deals, we've made it easier for you to consider whether one of those is the best option for your customer by removing the need for you to give a KFI. Or if you do give a KFI, it doesn't need to be precisely accurate. There are just a few more areas I'd like to touch on before I'm handing over to you for questions. One is the removal of the most suitable rule and its replacement with the client's best interest rule. Robert thought it might be helpful if I explained what change the FCA might expect to see in firms and advisors acting in their customers' best interests. What should be different either from the past or even from the behaviour seen today looking forwards? Well, I don't think we'd expect to see much difference. You all, I'm sure, would consider that you always act in your client's best interests. When you're acting as an intermediary for your customer, you owe that customer a duty of reasonable care as part of your relationship, and it's really nothing more than that. So, for example, if your client had one unfortunate blot on their credit record 3 years ago, I'm hoping that you wouldn't simply sell them a, for you, relatively lucrative credit-impaired product, which is a 10% interest rate. With their best interests in mind, and given their history, I'd like to think that you'd want to investigate the possibility of getting them a prime product. And that's basically what it is. Interestingly, the proposed mortgage directive includes a very similar obligation to consider the customer's interest. And of course, this highlights how, with the MMR, we've been very mindful of developing European policy and have used the MMR analysis to inform that legislation. I think just in terms of the directive, I haven't gone into this in any great detail, but I think we've still got quite a wait yet before the directive is finalised. But we've seen the text. We're pretty happy that the MMR is aligned with the directive. In areas where it's not, for example, European legislation will focus on disclosure. We've decided that disclosure is something that we don't want to focus on. We have deliberately not touched the KFI, which I think will be impacted by the directive. Similarly, on financial promotions, the directive is really quite prescriptive about what firms must include in financial promotions, and so we haven't touched that. So I think we're pretty well placed, actually, for the directive. One area that I just wanted to touch on was bridging loans. This is another area where we've tightened our approach. This is one of the niche markets where we've read across the MMR proposals and have added some tailoring to reflect that particular market's characteristics. I think on the conduct, there has been a concern about the prudential regime that's going to apply to some of these smaller firms. But on the conduct side, lenders are on the whole happy with where we've landed. But I just wanted to mention one area of contention related to credible repayment strategies. In the case of bridging finance, given the cost and the speed at which equity in the property can erode, it's really important for the customer to have a credible method of repaying, of exiting the loan. Speculative methods for repayment should not be accepted, and it's our view that an expectation on the part of the borrower that by entering into a bridging loan, their credit status is going to be repaired sufficiently for them to be able to refinance to a mainstream, longer-term mortgage product is speculative, unless the lender has some evidence of a guaranteed offer. Some lenders feel that will in effect ban bridging loans from being used for credit repair purposes, as lenders are not going to be in a position to guarantee an offer so far in advance. But for us, that sort of underlines the speculative nature of that. We've stuck by our views in the final rules. We really do think it is highly speculative to expect a customer's credit status to be repaired sufficiently for them to be able to refinance to a mainstream mortgage. Just wanted to mention as well, definition. We've defined a bridging loan as a loan of 12 months or less. And advisors must consider why it is that a standard mortgage isn't more appropriate for the borrower than a bridging finance. Okay. In a panel session at the CML conference last week, there was a very positive reaction to the MMR from a number of intermediary lenders. Importantly, all of them said there was a general consensus that the MMR is not going to result in any fundamental change in the relationship between lenders and intermediaries. But they did say it will drive up standards, and also that the fact that giving advice is central to the MMR will benefit the intermediary market. It was really encouraging to hear those lenders say that. I think one of the notable things about the fallout after the crisis was that although many brokers have left the market, and here you can see that it's really dropped fairly dramatically. But overall, the really interesting thing is that intermediaries' market share has shown considerable resistance. So you can see the number of broker firms that have dropped out of the market, but look at where the broker share is in relation to the total number of regulated mortgage sales. It's really quite extraordinary. It's really held up very well. And given customer preferences for buying a mortgage with advice, we'd expect brokers to continue to play a really strong role in the market. I hope you can agree that the MMR reforms acknowledge the important role you play. On the responsible lending side, lenders have been allowed considerable flexibility in deciding lending policy. And obviously for brokers, a one-size-fits-all doesn't add value. That's not where you add value. And giving firms that greater flexibility gives you the opportunity to place your customer with the lender that best meets your customer's particular needs and circumstances. And of course, the importance of advice is absolutely central to the new approach under the MMR. So what's next? Well, there are a few residual policy things for us to continue, notably a review of the data reporting requirements, which is what we immediately turn our attention to, because that data is required to support the supervision of the new rules. And there's a small matter of second charge lending and also the Mortgage Credit Directive headed in our direction. But as Robert said, the MMR now moves into supervision, and we will continue to work closely with the implementation team throughout the implementation period and with supervision teams more generally beyond that. I know that there has been a lot of concern, not only expressed by Amy, but also by the lender trade bodies about, we worked really hard over a very long period to get to this position where everybody can be relatively happy about where we've ended up. And what we don't want is for supervision then to decide that they're going to supervise against other standards. So it's very important to us on the policy side to ensure that the supervision guys understand the policy intention behind these rules. And we've set out at great length in fairly thick policy documents what the policy intention actually is. So there can be no doubt whatsoever about why it is that we've arrived at the package we've arrived at. We've worked for the past 9 months with an implementation team in supervision. So implementation started 9 months ago. We've been working very closely with them as we've finalised the rules. They understand the policy intention. We will continue to work with them as they move into training. They're going to go out on road shows. They're going to work with industry, and there will be a policy person with them as they do that. Big changes lie ahead, not only for you, but also for us. In April next year, subject to royal assent, the new Financial Conduct Authority, the FCA, will come into being, and it will be the FCA which supervises the MMR. It will not be the FSA. My colleague, Nausicaa Delphas from Supervision, is going to be explaining tomorrow more about how the FCA's supervisory approach will work in practice. Basically, that approach is tailored to reflect the risk posed by firms. So firms with the greatest potential to cause risk to consumers or market integrity will have nominated supervisors. The approach to supervising smaller firms has basically evolved from the TCF assessment programme and has been developed to ensure that firms are capable of identifying and mitigating risks to their businesses and customers. It's going to operate on a 4-year rolling programme, which means that you will be contacted once every 4 years. Finally, the elephant in the room, approved persons. I have to say, this is something that we remain committed to, and Martin Whately actually said this at the CML conference last week. He said that we are committed to it and it will come in after the FCA is up and running. At the moment we've got lots of systems changes to go through because of the regulatory restructuring, and that has meant that we haven't been able to deliver yet on approved persons. In the meantime, we do hope that we can work constructively with the market to find an interim solution, and we are proposing to bring together all the trade bodies to have preliminary discussions about this later this month. Okay, thank you. I'm very happy to take questions. Shall I come and sit down?
You want to take a seat for a moment? Okay, ladies and gentlemen. Questions? There may be loads. I'll do this as best we can, very quickly. It's going to be a question.
Right. You mentioned the responsibility now lies with the lender rather than us, although we would do all the diligence work necessary in preparing a case for the lender. But I just have a question. Where a client reaches a retirement age and hasn't got enough pension funding, but the lender is still willing to lend, and I'm still helping the client retain his property, can you remark on that, please?
Sorry, Robert, I'm having real difficulties hearing.
I think the question is around the fact that on a case where we may be lending into retirement, the lender may be prepared to lend, but in terms of these responsible lending rules now, we may think from a broking perspective it's a good idea, but is it okay if a lender makes that judgment, is it a safe place for the lender to be at that point, and us in terms of recommending it? I think there may be an area of still grey where the broker may feel uncomfortable about recommending certain things that may still be within policy tolerances of a lender, but may not be in the customer's best interest. I think there's still going to be shades of grey in some of this, I think, is I think the challenge. But you're saying the ultimate responsibility is the decision of the lender to lend, is where it sits.
The ultimate decision is for the lender to lend. It's the lender who advances the money, and the ultimate decision is theirs.
But the broker has to meet the lender criteria. So if the lender sets them out to lend in that market, it's fine.
Yes, I mean, the lender, you, on the best of the information available to you at the time, you will have an idea of where the criteria sit. The whole point about us requiring that the broker, at very least, considers the eligibility criteria of the lender is so you're not wasting that customer's time. And that you're not going to have hundreds of credit searches, because we've had problems with credit searches and things. So basically, all that you broker are required to do is, on the basis of the information available to you at the time that you're dealing with that customer in relation to the eligibility criteria, is to use that and to send it to that firm on that basis. It's then for the lender who will decide and has the responsibility for deciding whether to lend to that customer.
Okay. Another question, please. Take it into the middle. There's a microphone coming your way.
Okay, with the new transitional rules, there's been speculation that lenders may force clients onto a repayment basis for their mortgages. Have you got any comment on that? Would that be a likely outcome?
Are you talking about the end of an interest only?
Well, not necessarily the end of an interest only, but mid-term of an interest only. There's just been a little bit of speculation in the press and on Radio 4 that there could be a situation where clients with an interest-only mortgage are forced into a repayment.
Well, I mean, obviously, the lender has to treat their customer fairly. They would have to be discussing with the customer whether that was something that the customer gave. We wouldn't expect them just to write to the customer and announce to the customer that they're being moved onto a capital repayment basis. It has to be a two-way process, and they may want. I mean, the lender may legitimately want to explore that as an option with the customer. But we would expect them to do that, and we would expect them to treat the customer fairly and think about it. It would be inappropriate for a lender to put a customer onto a capital repayment basis and basically setting them up to fail, because then, of course, they're then just moving into forbearance, and it's not really helping anyone. They would move into forbearance, obviously, and the lender would be required to forbear. But is that solving the problem? So the lender does really need to think carefully with the customer as to what's the appropriate course.
Linda, does the one bit you didn't cover was I call the instant rule, the rule that came in the day after announcement, and in terms of how that deals with mortgage and property prisoners, effectively, in terms of stopping lenders from dealing with them in a differential way.
Yes.
Does that impact this market as well, or do you want to talk a little bit about that surprise that came at us all, really?
Yeah, I mean that surprise was. Sort of surprised us as well, actually, to be perfectly honest. We did have feedback which expressed concern about the risk that lenders may, what has been described as price gouge, those customers who are trapped. So you have a customer who has moved on to standard variable rate mortgage. They're stuck there because they cannot get the deal that they had before, because the lenders have tightened the lending criteria, so those deals aren't available. So they're stuck in the SVR. There was a concern amongst consumer groups, and consumer panel in particular, that those customers could be unfairly taken advantage of by the lender. And that's why we brought that rule in. There's been a lot of press comment about the fact that we did that because we had concerns about SVR increases recently that we've seen. In fact, that is not what this was about. when we did our analysis, we could see that most customers who are on SVRs today are actually better off, even after those SVR increases, than they would have been if they were on their original deal. So most customers today are choosing to stay on the SVR. So it wasn't about SVRs. What it's basically about is to stop lenders unfairly taking advantage of those customers who find themselves trapped. That's what it's about.
Another question. Do you want to... gentleman here. Oh.
Linda, I wonder if you foresee a wave of mis-selling claims about interest-only mortgages that we've sold in the past, whether they were sold properly or not, or whether the FSA will quash this nonsense before it starts.
Well, I think that we have said, Martin Whately at the CML conference last week was quite clear that, the fact that a lender looks at a repayment strategy is not guaranteeing that it's going to deliver. So I think that consumer responsibility is key here. I think that the research establishes that most consumers who take out an interest-only mortgage know precisely what they're taking out. Something like 90% of consumers, very clearly on the Policies research that was undertaken as part of the MMR, said they knew that it was an interest-only mortgage. So they know what they're getting themselves into. The lender sends that customer an annual statement. So every year that customer is getting a letter from the lender which reminds them that they've got an interest-only mortgage and it is their responsibility to ensure that the capital repayment strategy is on track. And that happens every single year. And I think it's going to be difficult. This is not PPI. When you sell an interest-only mortgage to a customer, they're in effect buying it. They're making a positive choice to have that particular type of product. And that's very different from what we saw with PPI, where PPI was sold to customers. And very often they hadn't the foggiest idea of what it was, what the terms were, or anything. So I think we're in a very different scenario.
My question is on the non-advice process being banned. So how will that affect lenders then when a client goes into a bank and a bank's selling them a mortgage? Is that going to be an advised sale?
If they sell a mortgage,
Yep.
Yes, it is, because in the branch is an interactive sale.
But if they're only selling a very limited amount of products available from that lender, how does that fit the best interest rule?
Because as long as that product is appropriate for the consumer, so they're not selling them something that is entirely inappropriate, then that's fine. The consumer has chosen to go into that branch, and if it is an advice sale, it will have to be an advice sale if they're selling something to them in the branch, and they will go through all the criteria that you need to go through in an advice sale. So they're basically assessing whether it's appropriate for the customer, and if it is, it's entirely right that they can sell that product to them.
Okay, can I just ask one more question, which I've asked several times, it's never been answered, right? If a broker sells a mortgage and it does the fact find and it presents everything to the lender, right? So all the information that the lender gets comes from the broker, right? The day after the mortgage completes, if the broker rings the lender says, I can't talk to you about the mortgage under the Data Protection Act. Can somebody explain that to me? Because I've never understood it in 25 years.
Well, I think that's the customer. I think and I've heard this lots of times, there has been a long-standing issue between intermediaries and lenders as to whose customer is it. From a pure FSA perspective, the transaction is between the lender and the customer, and you have an intermediary in between who's broked that sale. So the relationship is between the intermediary, is between the lender and the customer. And in fact, when we first discussed introducing mortgage regulation, they were just going to regulate the lender, and they didn't think about regulating the intermediary for that precise reason, that was seen to be the customer relationship. But I know that it's caused lots of concern and issues. I know there are lots of, I mean, the intermediary, I think at one point, Robert, you issued a paper saying, so what is the role of an intermediary? From the perspective of the regulator, it's the lender lends that money to the customer responsible for repaying that money to the lender, and that's really a key relationship.
I think the key to this sits about a whole load of what are actual legal relationships, which actually are often we all drop into almost accidentally, in that the customer comes in and we issue them a terms of business, and actually, as Linda said earlier, there is a legal duty of care, never mind what happens to be in regulation, that sits as part of acting as an intermediary on behalf of the customer. There's then another perhaps legal relationship between, if you're actually not directly authorised but actually in a network, a relationship between you and the network and the contract that works there. And there's some really massive issues around that in terms of who is still liable for the advice at that point. Now, because that will only last as long as that network lasts, and then it reverts back to the person who's given the advice, and that gets to a different legal place as well. Then there's a relationship between maybe the firm and the lender and what that legal relationship is. And none of us look at these contracts very well, or look at them and study them and understand them. And I think that's part of the issue we still have in industry, in that we keep walking into these contracts without standing back and thinking or negotiating hard about what they should be. I think part of where the MMR is bringing us to is thinking a lot more carefully about that interrelationship and what we get paid for and what the value is that we deliver, and maybe have to grow up in our negotiating a little. I think that takes us to a slightly different place from where we started. Given time, I'm afraid I have to draw this session to a close. Could I say thank you for attending? Thank you to Linda for coming and bearing her soul again. And ask you to say thank you to Linda for her clear peroration of the MMR.